Hi, I'm Jim, and I was retired. Remember these index cards? In college, I would often write a term paper on these, research the ideas, jot down some ideas on these cards, shuffle them around in the right order, and then write, usually on deadline. Well, in this week, I'm going to use these to discuss index investing, pun intended. I'll discuss index investing for a DIY retiree. Now, first, you have to decide whether you're going to be an active investor or a passive investor. Active investors attempt to outperform the market by selecting stocks that they believe will perform better than the market in the future. And passive investors just want to invest in the market. Numerous studies have shown that active investors rarely beat the markets. Over the past 10 years, just over 15% of active funds have outperformed the S&P 500 index. And personally, I would rather just pursue the passive approach and invest in broad-based index funds. Now, the definition of an index fund is a collection of assets that mirror a specific market index. Vanguard was the first to introduce a retail mutual fund tracking the S&P 500 in 1976. Now, common index funds track the S&P 500 or all U.S. stocks or Dow Jones Industrial Average or the Russell 2000 or the NASDAQ 100 stocks. Whatever index that you want to track in your investments, you can find an index fund to do so. Now, international markets use indexes for developed or emerging global markets, or you can mix a basket of indexes to create a global equity market. By the way, stay to the end of this video and I'll share some advice on types of index investing to avoid in your DIY retirement. But please first like, share, and subscribe to this channel if you like entertaining ideas from one DIY retiree. An index fund can either be a mutual fund, which is a club that pulls the money together to invest in the stocks of that particular index, or an exchange-traded fund, or ETF. And the fund buys all the shares and then sells shares of its fund like stock. Mutual funds only take on new members in their club at the close of a market day. ETFs can be traded throughout the day. You can go in and buy or sell ETF shares like a stock. If you invest in a mutual fund, your investment will be priced by that club. With an ETF, you can set price limits on your transaction to buy or sell an ETF. Mutual funds also generate capital gains based on the club's trading, as long as you're a member of the mutual fund, while ETFs only generate capital gains when you sell your ETF shares. And this difference in the structure provides ETFs with some tax advantages. Index investing offers several advantages. Investing in an index fund provides easy diversification across hundreds or even thousands of companies with a single investment. And this diversification spreads your risk across various companies. You can also invest in index investing at a lower cost, since you're investing in all those companies within the index without the active investment trading costs associated with buying and selling individual stocks. In contrast, actively managed funds incur these trading costs when they buy and sell individual stocks in the fund, as well as the research expenses required to analyze individual companies and sectors. And these costs are then passed on to investors in the form of significantly higher expense ratios. In a March 2024 ICI, or Investment Company Institute report, actively managed equity mutual funds averaged a net expense ratio of 0.65%, while index funds averaged a 0.05% net expense ratio. Though that sounds like a small difference of 0.6% in the net expense ratios, it can compound your investment costs over the decades of your DIY retirement. Similar differences exist in that ICI report for index ETFs with active equity ETFs, and yes, not all ETFs are index ETFs. Their net expense ratios are 0.45%, while index ETFs in this study were averaging a 0.15% net expense ratio. Again, this data is from 2023. I prioritize low-cost investing, and I therefore select ETFs with expense ratios well below that average of 0.15%. My focus is on this lowest cost, broadest based index investing. One of the early lessons I learned in my DIY retirement is to focus on a single predictable number, my net expense ratio for my investment portfolio. While I may not know what the exact return on investment or the standard deviation will be for the coming year, I can easily track and manage the net expense ratio by selecting low-cost, broad-based index funds. And in fact, I've shared this chart with you before from Empower. They have an ability to look at a retirement fee analyzer, and I've set it for all accounts. And you can see that my net expense ratio is 0.02% when you include the cash and other things that don't have expense ratios in my overall portfolio. The third advantage of index investing is investing discipline. Because you're a passive investor, you're following the index, not the latest new hot tip. Just go with your passive choice of selecting an investment in an index as opposed to the latest trends. Now, among the ETFs that I use are VTI, which tracks the total U.S. stock market with an expense ratio of 0.03%, and VIG, or the Vanguard Dividend Appreciation ETF, with an expense ratio of 0.05%. And by the way, both of these have versions in mutual funds with slightly higher expense ratios. Here's the VDADX, which has an expense ratio of 0.07%. Index funds can track a whole market like VTI or a specific sector like tech stocks or pharmaceuticals or energy or financial stocks. Index can also track specific factors like market cap size or characteristics like growth stocks or value stocks or dividend appreciation stocks like VIG. Some can even get too cute with thematic investing, like artificial intelligence stocks or crypto stocks. But be careful. If you're not smart enough to pick a winning stock, what makes you think you can pick the winning sector or the investment theme? And that's why I favor broad-based index funds. If you pick too narrow an index fund, you will run into problems with reconstitution dates when those that track with that index must sell stocks or buy stocks to make it track. This article in Financial Planning notes that this triggers higher trading costs that add to the total cost of ownership. Further down in the article, Alan Roth, the founder of Colorado-based Wealth Logic, notes that he wrote about this reconstitution issue back in 2010. When it comes to owning stocks, I say own all according to market cap. Not only do you avoid the index reconstitution issue, it's far more tax efficient, Roth wrote in an email to the author here. My total stock index funds pushed through no capital gains. And I get bragging rights as well. I bought NVIDIA stock at its IPO in $122.99 because it was part of my total stock index fund. No worries about reconstitution of indexes. Now let me touch on some additional indexes to avoid. I've already mentioned the problem with too narrow a choice, but I would also avoid expensive thematic ETFs. Here's an example of Motley Fool, who recently published this list of top marijuana ETFs for 2025, including actively selected indexes of global and U.S. cannabis stocks. Look at the net expense ratios for these weeds. 0.83% for MSOS, which concentrates on the U.S. cannabis stocks, or 1.03% for YOLO. YOLO? If you had put $100 of your retirement savings into MSOS rather than VTI a year ago, you would have spent $1 immediately in higher net expense ratios. It's actually 98 cents, but it's close enough to $1, rather than 4 cents for VTI. And for that extra buck, your retirement savings would have gone to pot. That $100 you put in a year ago would be worth $36 compared to about $126 for VTI. Now, the ETF Research Center, or ETFRC.com, is a great website that did those last 2 pages. And it has tools to look at the total cost of ownership of an ETF. And if you hear about one you'd like to explore, run the numbers for free. Ask whether you really want to pay any higher expenses. And if somebody says that they can show you an index fund that's better than yours, run the numbers. Make sure. And use this to show the advantage of a low-cost, broad-based index funds in your plan. Another index to avoid is anything with the word annuity attached to it, as in a variable index annuity or a fixed index annuity. Mixing investments and insurance is generally a bad idea. By the way, I've only discussed equity index funds and ETFs in this video. A future video will look at whether you should use bond funds and ETFs or individual bonds for the fixed income portion of your portfolio. I will conclude with my standard warning. I have no initials after my name, so take these as entertaining ideas from one educated consumer to another. Always do your own due diligence and seek out a professional if you need one.